Stock markets are fueled by stunning results from Nvidia as bonds also rally on morose PMI data released across Europe and the US yesterday. Crude oil weakens on demand worries, and well, the investors' attention will gently start shifting towards Jerome Powell's Jackson Hole speech due tomorrow. So welcome. This is Swissquote's Daily Market Talk. Amazing, simply amazing. Nvidia announced stunning results when it released its second quarter earnings yesterday after the bell. The company reported $13.5 billion US sales last quarter, so that was well above its $11 billion US projection, and said that it expects $16 billion US sales for the next quarter, up from $12.6 billion US forecast last quarter. And now I obviously believe them. And earnings also jumped $2.70 per share versus $2.09 expected by analysts, and they also approved $25 billion worth in share buybacks. I mean, there is nothing that an investor could ask for more at this stage. The market expectations were, sky high. I mean, the company expectations was sky high. The market expectation was sky high. The results went to the moon, and the forecast for this quarter is stunning as, well, the company is now expected to earn around $30 billion in the fiscal year 2024, as Nvidia is not and will not be concerned about the industry-wide slump in chips demand, and that's thanks to a decent surge in demand for the AI processors, as you know, in data centers. So it looks like magic is actually happening for Nvidia. So the stock price jumped 10% in the after hours trading to flirt with the $518 per share level, and that was pretty much what the option markets forecasted. And well, the rally in Nvidia shares is on, guys, because Nvidia will be jumping above the $500 psychological level today and will likely advance from there on the top side. Now, I know that not everyone is happy with the Nvidia's stunning results. I myself was very skeptical that Nvidia would actually report such sky-high results yesterday, but Nvidia sure has a boosting effect on technology stocks, if nothing, by confirming that all the talk in the latest quarters was not empty talk, and the results are there. So Nasdaq futures are up by around 1.23% at the time I'm talking here. This morning, the S&P 500 futures are also in the positive territory this morning, and further good news is that the yields are down from Europe to the US on meager PMI numbers released yesterday, and that is obviously the perfect combo for the technology stocks, which have so far this year been unquestionably the best place to be for investors in the S&P 500, because S&P 500's technology stocks rallied more than 35% since the beginning of this year, and they obviously do have more to gain. They are followed by, well, consumer discretionary stocks, which gained almost around 30% since the beginning of this year. So that's double the gains recorded by the S&P 500 stocks on average. Then we have industrials and materials that also posted some meager performances since the beginning of this year. They were mostly held back by the slow Chinese growth and could actually remain under pressure moving forward if the global economic data will continue showing weakness, even though the US actually does stand out compared to the rest of the world. And well, the worst place to be for investors this year was utilities, apparently, where stocks actually died by more than 10%. And this trend could actually continue in an environment of rising yields and high inflation, which makes actually low risk investments like in treasuries or money market funds, well, much more attractive. I mean, why would any investor buy utility stocks, boring utility stocks, which on average pay around 3.5% yield, rather than, well, 6 months treasury bill that's almost risk-free and that pays 5.5%, right? Or Why not Nvidia, which, well, keeps announcing amazing, stunning results quarter after quarter. Anyway, the US 2-year yield dipped below the 5% psychological mark after the PMI releases, as both manufacturing and services PMI in the US fell unexpectedly in August, adding a layer of complexity actually to the latest US economic data, as the US economic data was so far, well, so strong that Atlanta Fed's GDP now forecast for the third quarter picked up to 5.8% last week, remember? So this week's PMI figures, the weak PMI figures in the US, come as a cold shower to investors who have been actually trimming their recession odds. Plus, well, these mortgage applications in the US tumbled more than 4% last week, according to the latest data. The payrolls in the US, so the payrolls benchmark, show that there could be a more than 300,000 downside revision to job additions in the US, though you should note that this number is still better than 500,000 downside revision for the payrolls expected by analysts, and payrolls remain strong on a monthly basis even after that revision. But back to my PMI talk, the soft US PMI numbers came right after soft European PMI figures yesterday, because August PMI numbers in Europe printed even worse numbers than the ones printed in the US yesterday. The manufacturing PMI in Europe was actually slightly better than expectations, slightly better than last month, but well below the 50 threshold, so in the contraction zone. And more disquietingly, the Euro area's services PMI slipped below that 50 level, so to the contraction zone, and that was for the very first time since January this year. And what's even more disquieting, what's even more worrying in this PMI number is that, well, it falls into the contraction zone for the busiest summer month for mass holidays in Europe. So the future actually doesn't look promising to me for European economic activity. And as a result of these weak results, well, traders now price around 40% chance for a 25 basis point hike in the European Central Bank's next monetary policy meeting. So that's down from 55% before the PMI release. And the euro dollar tested the 200-day moving average to the downside yesterday, and the pair remains under the pressure of rising dovish voices from the European Central Bank. And the European bond markets also rally. The German 10-year yield, for example, fell more than 5.5% at yesterday's trading session, and we see exact same gloom across the channel in Britain, because all British PMI figures that were released yesterday were well below 50, and they came in worse than expected by analysts, pushing cable shortly below its 100-day moving average, which stands near the 126.35 level. The euro pound, on the other hand, fell to a fresh year low, as the continent, the old continent, is now expected to join the UK in its economic demise. So, this being said, I really think that it's still good to keep in mind for investors that these slow PMI numbers are one thing that could eventually actually convince the Fed and the ECB and the Bank of England to slow down on their rate normalizing policies, but they won't be enough if inflation remains high. So the European Central Bank, as the Fed, as the Bank of England, won't hesitate to push the economies into further economic trouble if inflation numbers don't come down toward their 2% monetary policy target. So, this set of morose economic data still kept the US crude below the $80 per barrel level at yesterday's trading session, even though the US inventories dived more than 6 million barrels for the second consecutive week last week. Now, trend and momentum indicators remain comfortably negative for the US crude, and the market conditions are actually far from the oversold territory. So that simply means for traders that there is still room for a deeper downside correction in oil prices from the actual levels. Now, the key level here to watch is the $78.40 level, which is the major 38.2% Fibonacci retracement on the latest rally in oil prices, and which should, if broken to the downside, call the end of the actual rally and call for a bearish reversal, which would then pave the way for a further fall in crude prices toward the 200-day moving average, which stands near the $75.80 per barrel level for the US crude. So, this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your messages and feedbacks. I hope this episode of Market Talk has also been helpful and insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. And subscribe, of course, to our YouTube channel for daily market comments. I will meet you again tomorrow. And until then, good day trading.